Medical Properties Trust Q2 2026 earnings are out, and we are starting right with the numbers. They delivered a top-line revenue beat of $259.28 million, which was against the $248 million expected.
Right. But the bottom line.
Exactly. The bottom line was a GAAP earnings per share miss of -1 cent. That's versus a forecasted profit of about half a cent.
And did they update guidance?
They did. Management targeted $1 billion plus in annualized cash rent by the end of 2026. But the market's reaction to this mixed print was just brutal.
Yeah, the pre-market drop.
Stock tanked 12.45% in pre-market trading, dropping down to 4.115 cents. I mean, that is hovering dangerously near its 52-week low.
Which is wild, right? Because if you look right underneath that headline, GAAP miss, their operational cash flow metric, normalized funds from operations, or NFO, that held entirely stable at 2,015 cents per share.
Okay, let's unpack this. For you listening right now, staring at a double-digit drop, those acronyms can sound like, well, just a wall of noise.
Yeah, fair enough.
Why did the market punish a revenue beat and stable NFFO? Before we go any further, let's briefly untangle that GAAP versus NFFO disconnect. Like, how does a real estate company post negative earnings on paper but maintain stable cash flow in reality?
Well, it comes down to a fundamental quirk of real estate accounting. GAAP, generally accepted accounting principles, it requires companies to deduct depreciation from their earnings.
Right.
So on paper, GAAP assumes the hospital building is just losing value every single year, wearing out. So MPT has to take this massive non-cash deduction on their earnings.
The hospital's still there.
Exactly. In the real world, that hospital is still fully operational. It's collecting the exact same amount of rent it did yesterday. NFO adds that non-cash depreciation back into the equation.
So it's the actual cash.
Right. It's the true measure of the cash hitting the bank account, and that cash flow, as we saw, remained rock solid.
And if the cash is stable, why the algorithm-driven panic? That pre-market drop screams fear.
It does. And our mission for this deep dive is to look past that panic. We need to dissect the massive debt restructuring they just pulled off, look at the ground-level health of their tenants, and see if the real estate actually justifies this steep discount.
Let's start right there with the debt. Because looking at what management actually did this quarter, it wasn't about growing the business.
No, not at all.
It was survival mode, aggressively moving to prevent a liquidity crisis. They announced a massive $2.4 billion private issuance of senior secured notes.
Yeah, that is the anchor event of this entire quarter, newly issued notes due in 2032.
And the proceeds from that $2.4 billion deal, they're using it to completely wipe out the impending 2026 debt maturities.
Right, taking that entirely off the table.
And it takes out roughly 50% of the 2027 maturities, too. So mathematically, the runway is clear. The next major debt hurdle isn't until 2028, which is about $600 million. Much more manageable.
If we connect this to the bigger picture, surviving the maturity wall is priority number one for any REIT. I mean, you can't generate long-term returns if you're insolvent tomorrow.
Exactly.
What this maneuver does is secure the balance sheet. By retiring that near-term debt, it improves their unencumbered assets to unsecured debt covenant cushion, pushing it up toward 300%.
We hear covenants thrown around a lot, but that's where the quiet leverage really lives, between a company and its lenders.
Oh, absolutely.
Let's break that down for the listener.
An unencumbered asset is basically a property without a specific mortgage attached to it, right? Owned free and clear.
Precisely. Bondholders look at that pool of free and clear assets as collateral. If the company goes under, those are the properties the bondholders seize.
So a 300% cushion means?
It means for every $1 of unsecured debt, MPT has $3 of free real estate backing it up. It provides immense structural flexibility. And in a turnaround environment, flexibility is your most valuable currency.
Flexibility is great, but I got to push back on the sheer cost of this move.
The interest rate.
Yeah. That $2.4 billion private issuance carries a 9.25% interest rate. And even with this fix, their debt load is still incredibly heavy. Adjusted net debt is sitting at $8.75 billion. Yeah, it's a mountain.
That's an 8.9x adjusted net debt to annualized EBITDA ratio, and interest coverage dropped to just 1.9x.
Those are undeniably heavy leverage metrics. To clarify for everyone tracking the sector, EBITDA earnings before interest, taxes, depreciation, and amortization for real estate, it gives you the purest look at recurring operating performance.
Right.
And carrying debt that is nearly 9 times that operating metric is, well, It's high, no way around it.
So taking on $2.4 billion at 9.25%. I mean, to me, that feels exactly like taking out a high-interest personal loan to pay off an expiring mortgage.
It's expensive money.
You do it because you have no choice. It
Yeah.
buys you time. You keep the house today, but you are stuck paying a punishing rate. If you do the math, 9.25% on $2.4 billion is over $220 million a year purely in interest. Does the sheer cost of this breathing room just fundamentally damage their future profitability?
It's a very fair challenge, and honestly, it's exactly why the stock is under pressure. The cost of capital is punitive, but you have to view this as necessary in
Well,
medicine.
the alternative is worse.
Way worse. Defaulting on those 2026 maturities or tripping a covenant would trigger a catastrophic loss of operational control. Lenders step in. By taking the hit on the high rate, management keeps their hands on the steering wheel.
Right, avoiding a fire sale.
Exactly. It protects the core portfolio. And crucially, it protects that $9 quarterly dividend. They declared it again this quarter. The 9.25% rate is the premium they're willing to pay to stay in the game while they fix the structural issues.
But to afford that expensive medicine and chip away at that $8.75 billion debt pile, they need cash. And they're getting it through aggressive portfolio pruning. They're targeting up to $1.1 billion in liquidity just from asset sales.
And we're seeing concrete execution there. The prime example is their Swiss joint venture, Infracore.
Right, the entity that just went public on the SS exchange.
Yes, that IPO generated $140 million in immediate cash for MPT. But the structural brilliance is that they still retain a significant equity position in Infracore.
So they get the cash infusion today to pay down debt, but keep the upside for tomorrow.
Exactly. It's highly efficient.
And they highlighted another imminent transaction for $172 million. Yeah. The metrics on that sale are staggering. A massive 60% gain and a 34% internal rate of return over their original investment.
A 34% IRR in commercial real estate is exceptional. That means for every dollar invested, they generated an annualized 34% return over the hold period. That's private equity level returns on a healthcare facility.
Here's where it gets really interesting. MPT is selling properties out in the private market at massive premiums, validating their underwriting. But the public stock is near 52-week lows.
The great disconnect.
Right. Is the public equity market just completely mispricing healthcare real estate? Or is management cherry-picking their absolute best assets to sell, leaving a weaker portfolio behind for the retail investor?
That tension is the central paradox of this earnings print. Selling premium assets at a 34% IRR proves the real estate has tangible worth. The buildings are valuable. But you touch on the mathematical reality of REIT growth here.
The denominator effect.
Exactly. You can't escape it. If you sell off your highest performing assets to pay debt, you shrink the overall asset base. Shrinking the denominator makes it mathematically harder to grow total NFFO in the future.
You just literally have fewer properties generating rent checks.
Right. Management is willingly sacrificing long-term earnings power for short-term balance sheet survival.
Which means as an investor, your focus has to pivot. If the base is shrinking, the properties they're keeping matter more than ever. So let's look at segment performance, starting with the bright spot, post-acute care.
The performance there is genuinely robust. We look at a metric called EBITDARM, earnings before interest, taxes, depreciation, amortization, rent, and management fees.
It's a mouthful, but it's basically the hospital's raw cash generation before the landlord takes a cut.
Precisely. Does the core business of treating patients actually make money? In post-acute, total EBITDARM is up $70 million year over year. Key operators like Median and Ernest Health saw 24% and 13% EBITDA increases.
Wow. And the rent coverage for the segment is a strong 2.4x. So they generate 2.4 times the cash needed to pay MPT's rent. They have a buffer.
A very healthy buffer. General acute care, their largest segment, is also stable at 2.8x coverage. But strategically, management made an interesting structural move here. They consolidated the Scion Health and LifePoint leases into a single master lease.
Master leases are a fascinating tool. It's not just a bulk discount, right?
Not at all. It's an aggressive defensive mechanism. It cross-defaults all the properties in the contract. Imagine an operator has 10 hospitals, 7 are highly profitable, 3 are bleeding money.
Without a master lease, they could just bankrupt the 3 bad ones and hand the keys back.
Exactly. Keep the 7 good ones. But the master lease binds them. Pay the rent on all 10 or lose the legal right to operate the 7 crown jewels. It effectively holds the profitable hospitals hostage to ensure the struggling ones stay open and paying.
But a master lease can't fix an industry-wide problem, which brings us to the major drag on the quarter, behavioral health.
Yeah, it was rough.
Rent coverage dropped sharply to 1.4x. And the earnings materials specifically blame funding constraints from the UK's National Health Service, the NHS.
And we need to look at the why. The NHS is a single-payer government system. They have huge waitlists for behavioral health, so they outsource to private facilities, the ones MPT owns.
So the patient demand is there.
Infinite demand. But the funding is capped. The NHS dictates the reimbursement rate, and they are facing severe budget constraints right now. Rates are stagnant.
While the private operators deal with inflation.
Exactly. Cost of psychiatric nurses, utilities, food, it's skyrocketing. Costs go up, revenue per patient is capped, the profit margin is completely squeezed out, dropping rent coverage to 1.4x.
I have to ask, is this behavioral health struggle the canary in the coal mine for MPT's international exposure? There are 9 different countries.
Yeah.
The conventional wisdom is that you diversify internationally to avoid U.S. regulatory risks.
Right, like Medicare cuts.
But looking at the UK, it seems like you just trade one risk for another. You mitigate U.S. single-payer risk, but you absorb localized sovereign political risk abroad. Are they actually recession-proof when operators are at the mercy of government budgets?
What's fascinating here is how clearly this illustrates the limits of that conventional wisdom. Diversification is a double-edged sword. You spread your bets, but you multiply the sovereign regulatory regimes you're exposed to.
It's just more moving parts.
Exactly. A 1.4x coverage ratio means those UK tenants have almost zero margin for error. If inflation spikes again, they could dip below 1.0x, meaning they bleed cash before they even write the rent check to MPT.
Which brings us back to the U.S., because we can't ignore the tenant drama here. The biggest dark cloud over this stock has been the highly publicized struggles of specific operators, mostly the Steward Health fallout.
The market is absolutely desperate to see if rent collections are normalizing there.
And the report did give some timelines. HSA Prospect Medical Holdings is currently paying 75% of contractual rents. Management guides a step up to 100% by mid-September.
And Noor, who took over several facilities, started paying 50% in mid-June, expected to hit 100% by mid-December. So there is a mathematical path to stabilization.
But it wasn't all clean. They had to record a $17 million impairment this quarter.
Right. That was a write-down on working capital loans given to 2 Steward replacement tenants in the Midwest.
So let me put this in terms of being a regular residential landlord.
Okay.
Say you rent out a house, your tenant stops paying, gets evicted, you find a new tenant.
Okay.
But immediately, that brand new tenant needs a personal loan from you just to buy groceries. And then a few months later, they default on that personal loan.
Yeah, it's messy.
Isn't that a glaring red flag? Doesn't a $17 million write-down mean the underlying hospital operations at these Midwest facilities are still bleeding cash?
It's a vivid analogy, but we have to adjust it for healthcare real estate. A hospital is not an empty house. It's highly regulated, life-critical infrastructure. If a residential tenant stops paying, you change the locks. If a hospital operator stops paying, you can't just lock the doors.
Because there are patients in the ICU.
Ambulances are diverting there, the state health department intervenes. If the facility closes, the REIT risks losing the specialized licensing that makes the building valuable.
So the landlord is effectively trapped. They have to keep the lights on.
Trapped into funding the transition, yes. Replacing a major operator like Steward is never plug and play. The REIT often has to step in like a bank, providing working capital lifelines funding payroll just to stabilize the new operator so they can eventually pay rent.
But a $17 million complete write-down right out of the gate.
Oh, it stings. It's a localized failure. But keep the scale in perspective. A $17 million impairment is a rounding error against an $8.7 billion debt pile and a $14 billion asset base. The crucial metric for recovery is the successful ramp-up of HSA and Noor. If they hit 100% collection, that cash flow completely overshadows the localized Midwest impairment.
So synthesizing this highly complex quarter for you listening, yes, GAAP earnings missed due to depreciation. Yes, the stock took a brutal double-digit plunge. But strip away the noise, NFO was stable at 0.15 cents.
The cash is there.
The $1.09 dividend survived. And management successfully dismantled the immediate 2026 and 2027 debt cliff.
They bought the time they desperately needed. But it raises an important question for you to mull over as you model out MPT's future. Let's assume management executes flawlessly. They stabilize the facilities, HSA and Noor hit 100%, the UK NHS increases funding.
Best case scenario.
Right. Even in that scenario, will that heavy 9.25% interest rate on their newly issued $2.4 billion debt act as a permanent anchor? Will it eventually strangle the very profitability they just fought so hard to protect?
It's the ultimate paradox. They paid for the expensive surgery, but the cost of the operation might leave the patient in suffocating debt for the next decade. Thank you for joining us for this deep dive. Make sure you follow the show for daily earnings coverage just like this, keeping you ahead of the print.